All right. Hey, good afternoon, everyone. Welcome. It's 1:20, just right as the market's closing. Let's look at that, and then I want to jump into the balance sheets with you here for just a second, okay? So corn looks like we're going to close it right at 24, 25 up. This is the December corn. This is your daily. This is your 4 hour. This is your 1 hour chart. And let's just take a look at where we're at, okay? So you can see exactly what it is that we're looking for and what we're looking at. We had drawn this box on here earlier this week as an important area of resistance that we wanted to see hold. So as you can see, we're putting pressure right on the top side of it. Okay, that's this extreme right up in here, which would be the prior fourth wave. We've broken up out of our daily cloud. We're breaking up out of our downtrend line or out of our upward corrective channel. And the only thing left here standing is this downtrend line that started from last summer. Let me zoom out here a little bit so you can see that. Okay, so we come all the way down from last April all the way through today, and we're putting pressure on that line. Now, what's got the market going here this morning or today is yet another delay of moisture, right? So you've got this donut that's formed right around northern Iowa, western Illinois, Wisconsin, southern Minnesota. And in that area sits roughly 70% of our domestic corn crop and somewhere between a quarter and a third of the world's corn production. So you put stress on that size of world corn crop, you're going to put pressure on prices, and you're going to put premium in it until it rains. So we're seeing that happen. Now, some other things that are significant here today are that our force index got more strength. Volume was very, very good. Momentum is very strong. We started a bullish crossover over here on the Kumo, and we're above where we were 26 days ago. So this chart is starting to look more and more bullish. So let's back out and look at a longer term perspective here, okay? Let's figure out why it did that. Just a sec. Okay, here is your weekly chart of December corn. Now remember, this has not closed yet. So if we're up another 25 cents tomorrow, we could be up above here. Now, remember last week? Last week was a bearish engulfing week, okay? Where our, let me zoom in on that a little bit more, where our open and close fully engulfed the prior week's open and close. Okay, so that was a bearish development right on the bottom side of this downtrend channel. So all systems looked good for lower here. Now, obviously, you can't break a market if it's hot and dry, so a little bit of a bounce was acceptable. What we don't want to see, well, we want to see it happen because higher prices are a lot more fun to trade than lower prices. So we're perfectly fine watching prices go higher, but what we don't want to do is get caught short if we break up above this weekly cloud, and that seems like it's a long way away, but you got a lot of resistance right here. So if rains materialize, rest assured this thing is going to come back down and drop like a rock. But if rains don't materialize and we really put pressure on this crop and we start to decrease the actual yield size, then we're going way higher. And we haven't been too worried about that because if we do burn Iowa up, or that whole region, if we burn them up significantly, then our yield is going to be so low, we're going to contract our balance sheet in $6, $5.70. It's going to be, we're going to leave it in the dust. We're going to blow through this high, and we're coming way higher. In fact, if we run a retracement factor here, why is this not wanting to work for me today? For some reason, that's indicator's not wanting to work for us here today. But what it would show us is our projections way up higher. So, and that makes sense, right? If we burn up Iowa and we contract our balance sheet to below pipeline, then we're going to ration and we have to go to all-time highs. 850 is not going to stop it. Who knows where it goes? Could be 950, 10, 11. Who knows? And I'm not saying that's what's going to happen. What I'm saying is that we got to keep our risk reward in mind here, because if we do rain, then we're coming lower and our risk is still down. If we do go to $8, $9, $10, then, and I don't mean this in a flippant way, who cares about 5 to 6? If we're going that high, we're not worried about this much. We're much more worried about it turning lower. So, so hedged is where we still want to be as of today. We're putting way more pressure on this than we thought it maybe should, but the forecasts are still forecasting rain coming in the next week to 10 days, and the moisture pattern, the pattern shifting to a much wetter, much cooler period. It hadn't happened yet, so we're going to keep buying it until it does. But from a long-term perspective, this is where we are. Now I'm going to go back to a continuation chart here so you can see what that looks like. My computer is awesome today. Let's look at this one. Okay, so here is just the weekly continuation of corn on a continuation chart. So what is a continuation chart for those of you that don't know? Continuation chart means that we're putting up here always just the most recent, just the front month contract, okay? So when you ignore all these hedge lines and everything else, because I literally change time frames on you and change charts, because at this point all we are plotting are is the most active front month. So this is now plotting the July contract, not the December, and it's going, you know, July, then it was May, then it was March, then it was December, and backwards and backwards. This is always the front month being charted. And the reason I'm showing you that is because if I go back to the beginning of our records, which are, you know, back in the 70s, when charting as far back as our charts go, and if you've been with me a long time, you've heard me talk about this, which is the weekly Kumo cross. When we break out of the top of the weekly cloud on the continuation chart, that's when bull markets really get rambunctious and get crazy. The average is like $2 a bushel or more. Look at where we are. We're nowhere close to that yet. We've got a long way. If we do break out the top and we are able to take the front month above $7, it would forecast to probably $9.50 or worse. Okay, it goes way, way higher. Again, this is all part of the reason why we're not overly concerned about higher prices. So now let's go back to the daily chart. This should be back to just the December daily chart. Not yet. Okay, here's your December daily chart. Yes, we broke up out of the daily cloud. Yes, we are putting pressure on all these areas that we want to see hold, and we could easily continue on higher. So, like we've been talking, where do we want to be? Well, you want to be long calls, and you want to be short futures or have your hedges in place. You can always adjust it later, but that gets you in protection, which is where all of our people are here, sans a few, and we'll work to get those short puts and short calls and short theta out of the or short delta out of the equation sooner rather than later. But I kind of want to see what it does in the overnight and tomorrow. But no doubt about it, corn is hot. Now let's look at soybeans, and then I want to go through our balance sheets. All right, here are new crop beans up 50 today. Lots of strength on this contract. It is overbought, but you cannot ignore the fact that it's up 90 cents in 3 days and on relatively low new news, right? Exports are terrible, but domestic demand is screaming and it's on fire. So something's going on in the bean market that that we need to stop and reflect on and say, hey, what is actually happening here? And if you remember, a few weeks ago, we thought, man, this market could start turning bullish just because of the price action. This is several weeks ago. We were too early. We didn't. The action was looking similar to today, but it was we're trading in the no man's land, and we started to turn bullish, right? Which is why we wanted to lift corn hedges. Well, we were wrong. We put those back on, and now all those fundamentals that were presenting themselves several weeks ago are coming to pass. So the indicators were actually forecasting it, and then they took it away, and then they traded again, which is why you have to always take the next position and the next trade, because eventually they'll be right. Now, with beans, we're way overbought, but I want to show you why they're so exuberant. And I've got to pull up our balance sheet. Let me make sure I've got the right one on here. June, yeah. Okay, this is the right balance sheet. What I want to do is just show you a yield, okay? If we start to see, well, let's do beans first. If we start to see demand creep up, remember the USDA increased demand by a little bit, and if we do see demand hold here and not shrink, because our domestic crush is so strong and we actually hit this number, then look at the pressure it puts on yield. Okay, this is 374. This is a really healthy balance sheet, okay? USDA says we're at 350. This is 374 with a yield of 52 and 87.5 million acres. So roughly 375, 365, somewhere in that area. Watch what happens when you start cranking this yield lower if we get in trouble. Okay, just watch this balance sheet work its way lower. There's 288. Okay, let's take off another bushel. This is 50 bushel an acre. Now we're at 201, we're at 4.5. We're tighter than we were last year. Now let's do something crazy and go to a yield of a couple of years ago, which is 48.5. And now all of a sudden you're well below pipeline and you're effectively out of soybeans. So if that becomes a reality and we drop 3.5 bushel an acre off of the soybean yield, then beans are above 20. That is way too tight. It will ration. It has to do it. So that's why beans are putting a lot of pressure on the front months. You know, if we come back, let me get this off the screen here and pull beans up. And let's just look at the different months. This is a November up 50. And then let's look at September, SEU 23. If we look at September, you know, it was up almost 60 today, right? So you're putting premium in the front month in the old crop contracts versus the deferred, because that's where you have to ration it if you're going to do it. So if the trade starts to really discount that yield and thinks that that bean yield is coming lower, then off like a rocket we go. November beans don't stop at 13 or 14. You know, they go way higher because we can't afford we can't let them run out. So that's what's got the market kind of spooked at the moment. It's too soon to go price that in all the way because this isn't real, right? The USDA is still here. So we're still growing our carryout and we have plenty of soybeans, but there's no margin for error on them if demand is present. What we had kind of thought might happen, and this is what the current numbers look like, okay? So let's go 87.5, let's go 86.7, let's go 86.6 harvested acres, a 52 yield. Let's say we have really weak demand, so we start to decrease, we start to decrease demand. When we do that and we find old stocks and we decrease the demand with this yield, then we really grow big. And why do we think that that is still a possibility? Well, because South America's crop is so big. You know, they grew a perfect one. They're going to plant another one, and high prices ultimately cure high prices, so they outsupply it. So your balance sheet is now talking about demand that could still do this, but now weather that could drop us down to somewhere in here. So you've got this overwhelmingly wide range of potential carryouts, which is causing the market to be really volatile. And that is okay, right? Because this is probably $8 beans and that's 20. And that's the range of beans that you're really looking at. And we're currently trading 14.28 on July's and 12.90 on the new crop. So we're kind of mid-range to where we could be on soybeans. So let's not stick our head in the sand here. Let's not trade this number yet, but let's assume that the tighter the weather gets, the more pressure that puts on the buyers to go secure supply. So the bigger number that gets, the lower this one goes. Okay, are you with me? The more fearful the international buyers get, the more likely they are to buy and have a perfect storm of higher demand with lower supply, because that's just kind of how human psychology works, right? And in fact, we've been seeing the opposite of that. We've been seeing the hope of higher prices cause buyers to be greedy and decrease demand by slowing exports. So if the opposite happens and they start to get fearful, then It's that kind of psychology that could really blow the top off. Okay, so now what about corn, right? Surely we've got plenty of room there. USDA says we're at 2257, up from 1257. We're up a solid billion bushels from a year ago, and why would we have any problem? Well, let's do the same math, okay? If you have if you have a big event that really does burn up that big production area, and let's just say that demand also hits where the USDA says it's going to hit. Okay, remember they raised this 600 million. This is not in the cards yet, but let's say it does. And let's say we drop this yield to 165. Bam, we're below pipeline. We're at all-time highs. So the pressure is really on these rain forecasts to materialize. Otherwise, we are going to blow through the roof on these prices. That is big picture what is happening in this market, right? You could be seeing the beginning of the psychological pressure getting put on the buyers to not rely on not cut demand because of high yield, right? Because they're getting greedy. You're now seeing the opposite, which is fear being put in them that the weather is getting too dry, so they may start to buy. And if that happens, up we go, and we're going to be up and out of here like a rocket. So lots to come. We do have a 3-day weekend coming up, and we have so we expect a lot of volatility tomorrow, Tuesday, Wednesday, Thursday, Friday, as these rains materialize. If the rains happen, I think we drop like a rock. If they don't happen, then I would think we will chop until we get there, and then if they don't happen, we're going to blow up out the top of these things with some exuberance. So get ready, stay by your phones. We will trade from these areas because it's too much. The reward is too great, both sides not to, but it's going to be difficult. So we're probably going to be looking at some spreads. We want to be long above it. We want to be short below it. So we're going to be looking at some spread type trades to try to capture it, because I don't think we'll be fast enough to pull the trigger on futures long and then flip and get short. I think you got to spread it in here, and you got to be pretty cagey on what your position does, because you've got time, you got volatility, you've got price. You got to manage all three in space against the right contract month. So very complicated, a lot of calculus going into that, right? So and only the best way to manage it is to be totally keep it simple. We're gonna get long and longer above these clouds, and we're going to get short and shorter below these clouds. So keep that reownership on for the moment. If you don't have it on, put it on, and we'll manage from there. So that's a lot. That's 18 minutes, but I hope it gives some clarity, big picture on why we're seeing the volatility we're seeing and what we should expect moving forward. This upcoming rain or lack thereof isn't $1 million rain. It's a $20 billion rain, right? It's a big deal coming up because we cannot afford globally to burn up Iowa. All right, lots of fun coming. I hope you guys have a great night. We'll be back with you tomorrow at the close so you can see exactly what's going on. Have a great night. We'll talk to you soon.